Morning, everybody. Can you hear me well? We tested it yesterday, so we almost don't need the mic. But this is the 6th annual Breard Associates hosted or co-hosted seminar, the broker-dealer industry update. And I think we've got a few more people who will be showing up in the next several minutes. I remember our first couple of seminars. Brian Zucker, who's sitting back there, will remember it well. We invited our family, hotel staff, and their favorite bartender, and our Fantasy Pool League friends to join us just to help fill up the seats. Well, we've persisted, and this has kind of become, as I say, an annual event about this time of year. And what we try to do, the overriding purpose of putting on the seminars, but to provide an informational update on the current state of the broker-dealer and RIA industry, discuss current trends, and analyze topical issues, which is exactly what it will be like today. And we have 3 distinguished speakers we're offering today. Unfortunately, none of them can make it, so we have our, just kidding there, to offer their perspectives and expertise on things that affect the industry most. We'll save time for questions at the end, but feel free, as all the speakers have agreed, if you have questions during their presentation, just raise your hand. I think we can provide a mic, or more likely than not, we can probably just hear you as well. So with that, we can, if you've got something that pops into your mind as a speaker is making a point, you don't have to wait till the end or jot it down. You raise your hand and they'll be happy to answer it at that time. That adds a little bit of spontaneity, we also feel, to the presentation. Before we begin, a couple of custodial things. The bathrooms, in case you haven't had to go yet, are through that back door and straight back. The cell phones are off, of course. And we have, one of the reasons we chose this particular little setup here is there's a nice ante-room outside. So if you have to take a call, answer a message, whatever it might be, feel free to just go out the door and take care of that, and you can pop back in. We will also, if you want to wait, we'll have, with the 3 speakers, we've allotted about a 10-minute break after each speaker for the next one to set up and for you to go out and refill your coffee or have a roll or whatever you want to do. So we have, we're not on this button-down military schedule today. We will allow for some time and some interaction. A couple of you who I know have just met, and it's a nice opportunity to be able to do that, and that's part of the purpose, as well as to meet the speakers. Now let us get into the program here. And our first speaker today, and he has traditionally been the leadoff hitter, he's the Dexter Fowler of the team. Kevin Breard has had over 30 years of experience as a CPA, FinOp, and CGMA, and a financial industry expert and analyst. And he began Breard Associates 26 years ago to provide a broad range of accounting and auditing services to a diverse clientele. And today, having sort of evolved into a specialty in the broker-dealer industry, Breard Associates is the 5th largest provider of broker-dealer audits in the United States. And our presence here in New York has increased significantly over the last 7 or 8 years. That's been a lot of what I've been involved in because I share time between New York and California. But Kevin is a frequent Stafford webinar host and speaker on issues relating to broker-dealers, contributing author on Financial Statement Fraud Casebook, Baking the Ledgers and Cooking the Books, and he's also written a number of articles for the Journal of Accountancy. Today, I don't know if you want to call it doom and gloom, but Kevin discusses the current state of the industry and where it is trending and what new regulations, he will touch upon that, what new regulations we can look forward to and have to deal with. Please welcome Kevin Breard. go behind you.
Good morning. You can hear me okay? Good to see a lot of people here. Good to see some friendly faces. And we're also doing it via streaming today, so we'll have a lot of people I know listening and watching. You know, when you prepare for a presentation, it's a lot like packing. You want to make sure you don't overpack, and you want to make sure that you pack enough stuff that's going to be wearable. And for some reason, you always seem to want to pack stuff that are your new threads. I hope that stuff never gets lost. So let me show you then our little presentation. As a speaker, I know it's important for listeners to see where I'm going. I will have 7 topics. First, as Rod alluded to, the doom and gloom of the financial industry overview. Let me show you where you guys are. I always think this is very interesting. The second thing, cab rules. These are brand spanking new. These came out October of last month. And that's why you're here, is to catch the new stuff. And I think there's some people in the audience that may qualify for cab. We'll talk about them, what they are, what they're not, and why you may want to go into them. The second thing is the SIPC rules. For everybody that files broker-dealer audits, SIPC rules are changing. We'll go through that. Third thing, relief from prompt delivery. You know, as an introducing broker-dealer, probably one of those questions you had to take on the exam years ago, what was timely remittance? Was it 2 days? Was it 1 day? Was it 24 hours? There's now relief from prompt delivery, and I think it was a landmark decision that the SEC had in a no-action letter. And we'll go over the specifics on that. I think it's very interesting. Crowdfunding. Paulo Argento will talk about crowdfunding. I'll talk about it in about 2 to 3 minutes, just so you have a walking knowledge of it, just so you know a couple things. If you guys are broker-dealers, someone asks you about crowdfunding, you're not going to say, I don't know, let me go to Google. You're going to try to answer a couple of those questions. Let me help you today with just some working knowledge on that, a takeaway. And, oh, well, the future is going to be brand new, so we'll talk about that. Then I'll wrap up my presentation. All right. Financial industry overall, membership trends, and enforcement. Enforcement is an area that Dennis McCarron works in that perhaps one day he'll do a whole presentation on that, and he'll be speaking a little later today about registered investment advisors and DOL and fiduciary rules changing. And then I'll talk about enforcement. You guys probably be interested to know where the fines are, how big the fines are, and what the trend is. Hey, what's the trend in restitution? We'll talk about some of this. All right. Whereas you're familiar with the industry, the orange line, number of broker-dealers, are also down here on the bottom. So about 5 years ago, 2012, you're about 4,300, and now you're a precipitous slope. You're going down. And the blue line is registered investment advisors, and you can see around the year 2014 it crossed. There are trends in the industry for broker-dealers where they are decreasing in number. The growth between 2012 and 2012 to 2016 was about 1.8%. Projecting the next 5 years forward, growth, about 2%. So it's a mature industry. I'm not telling you anything new, but there's not going to be a lot of growth in it. I will talk about some new areas of growth and understanding doom and gloom. It's not just broker-dealers. Look at this chart. In the red is single office banks. In the orange is banks with branches. You can see you had 10,000 back in 1966 as single offices, and now you're probably under 2,000 in the year 2014. Likewise, you can see the decrease in number of commercial banks with multi-branches. If I was to show you a credit union slide, because I'm a board member of a credit union, you'd see the same thing. The industries, the numbers are collapsing. Why they're collapsing? That's not part of this presentation. Let me talk about the trend in FINRA fines, and I find this very interesting. January to June of 2016, 79 million in fines. We'll call that 80, just to round. Now, if we hit 80 for the last 6 months of the year, well, FINRA members, congratulations, because then you'll set a record. The record was 134 million back in 2014. I'm not encouraging this record. I'm just pointing out this is the record you're at. And by the way, there were 4 firms expelled during the first 6 months of the year. Here is a trend in FINRA fines. I've jokingly, for some reason, this is the term, the nomenclature in the industry, supersize. Supersize fines are anything greater than $1 million. Then there's a new term, ginormous. That's anything greater than $5 million. So you'll see from 2015 to 2016 for the first 6 months, we got to do apples to apples. First 6 months, you have about 5 supersize fines, but in 2016, you ratchet up to 7. Now, look at ginormous. Over $5 million in fines. Only had 1 in 2014, but 4 firms hit that in 2016. That's why 2016 is so high, 57 million. I talked about 79 million a couple minutes ago. 79 million, well, here's 57 of it. And the trend is not good, because the trend is large fines are trending upward. Enforcement actions. In alphabetical order: AML, due diligence, notes and bonds, proprietary trading, variable annuities. Alphabetical order. Let's go where the dings are. Where are people getting hurt? Variable annuities. Notice the first 3 are all within $1 million of each other. Variable annuities, 21 million. Due diligence, 20. AML, 19. Trade reporting, 13. And notes and bonds, 6 million. Notice number of cases for variable annuities. 7. That generated $21 million in fines. And regarding trade reporting, most frequent, but certainly not generating the most in revenue. Trend in FINRA restitution, good news. Restitutions are down to about 14 million, and in prior years you had 96 million and you had 32 million. If 14 million is the first 6 months, and you go 28 million for the whole year, you'll be 71% decrease from the 96 million in 2015. Disciplinary actions, roughly about 550 for the first 6 months of the year. Roughly the same. People at the FINRA office are busy. TV news reporters, they got to be honest people. I mean, everything they say and the internet has to be true, right? So there was a gentleman on from the Fox TV news, because that always stirs a little bit of interest when I say Fox, had a conflict of interest, and he was pitching penny stock. It was the perfect penny stock. Well, it was also the perfect penny stock for him to pitch because he was getting compensated for it. He got compensated very nicely. His fine, $75,000, disengorgement, $182,000, and by the way, he won't be talking about any penny stocks in the future at all. Barred.
Did he lose his job?
Yes. Financial industry. Honey, the bank stole my identity. It's Wells Fargo. 185 million, one of the largest fines handed out this year. Just wanted to mention that. Oh, and by the way, when you talk about market share for your industry, do you know who has the largest market share? I'll refer to my notes. Do you have any idea? I was wrong. Bank of America has about 7.9% of the market share, broker-dealers and securities. Wells Fargo, 6.6%, and JP Morgan, just under 4%. So I find it interesting that the banks are so heavily, such a heavy portion of the whole population of securities. I talked about fines for broker-dealers and disciplinary action. I think it'd only be fair if I talked about fines to CPAs. CPAs continue to get fined for audits of broker-dealers in securities. And then not only fine, but other repercussions. In September of 2016, the PCAOB, the Public Company Accounting Oversight Board, who reviews broker-dealers, fined CPA firms about $40,000. They barred one firm from accepting any new broker-dealer clients, and one firm was barred from practicing before the Security Exchange Commission, which effectively means cannot do broker-dealer audits for a year. These are very, very heavy fines. Brand spanking new, and that's the idea of this presentation, a CAB. Capital Acquisition Broker. Brand new. And so many of my clients throughout the nation fit into this category. In January of 2017, the capital membership applications will begin. In April 2017, the rules go effective. I know you like to look at the references. I understand the audience I'm speaking in front of, and here's the reference. The reference is about 5 pages, and I'll try to go into those 5 pages quickly with the slides. I'm going to tell you what CABs are subject to, what they're not subject to, and I think you may see the light. Well, there is the assumption that all broker-dealers fit into one set of rules, one size fits all. Well, this idea is not strange because my profession, the accounting profession, we have generally accepted accounting principles. And for the longest time, we've talked about a big gap and a little gap, having a big playbook for publicly held companies and something smaller, more manageable for the private companies. Well, the CPAs failed, but you have succeeded. FINRA now has a new subset of rules, especially for CAB members. And although it's hard to say, it may be an attempt at some deregulation. And I didn't think I'd ever say that in a world of mounting compliance. Does your BD fit? So let's take a look, and I'll kind of go through these. So what is a CAB? They engage in limited range activities, meaning they are doing capital raising, they are doing refinancing, they are doing restructuring. They will tell companies whether they're going private, whether they should merge, whether they should diversify. A CAB can act as a placement agent for institutional investors. And I know of a firm in the Chicago area that does litigation support. They have no idea why they're really a broker-dealer. I don't know why they are either, but now they can elect the CAB status. Who's not a CAB? Well, if you're an introducing broker-dealer, you're going to handle customer accounts. If you're holding customer accounts, if you're accepting orders to sell securities, you got to get in your head that if you're a CAB, you probably don't have a clearing agreement. Yes? That I don't know. Thank you. I don't. Prop trading, market making, and you can't be doing any kind of Reg CF, which is the regulation for crowdfunding. So can't do any of these things. Now, what is the advantage to being a CAB? Well, you're not going to be subject to certain things. Some people who are very good in the profession will just say they're 2120, 2122, and 2124s. But there's what they are, fair pricing, because you really don't have a customer out there. You're renegotiating with a company they're financing. So they're not subject to these. This is the 2000 series. Hey, they're not subject to some of the 4000 series. The business continuity plan and the mandatory participation in some of the FINRA testing, the 4000 series, not subject to this. This is wonderful. I tried to explain that CAB has a new set of rules, that most of the FINRA rules are in the 1000 series. CABs are in the 100. For example, Rule 452A, limited set of requirements for the supervision and review of the firm's general ledger account. I figured this is something that's good, got to cut down some time. Limited set of supervisory rules. And how many firms get busted for the last one, the OBA, the outside business activity? But, influencing and rewarding employees, borrowing or lending to customers, not there. AML. Dennis, this is one of your favorite topics? AML, man, I showed you the chart where they came in high, number 3rd on being banged. AML, independent testing for a broker-dealer. I'm not telling you anything new, it's annual. For a CAB, biannual. And biannual means every 2 years. Now, CABs are subject to some of the FINRA rules that you would expect. The arbitration and mediation rules, but that only makes sense in the long run. They're easy to get into. You do not need to file a new membership application or a change in membership application. Don't have to file that. All you have to do is amend your membership agreement. Hard for me to believe, but that's all they want you to do. Now, if you're going to be a new member coming into FINRA, then you have to go through the CAB process of the NMA. I'm going to refer to this comedian as I conclude my speech, but I think this summarizes the CAB rules. Just because you got the monkey off your back doesn't mean the circus has left town. And I think you'll see the wisdom of that. FINRA is still going to be around, but it's a little lighter. The Security Investment Protection Corporation. Yes.
You want to take a question about the rules?
Yes, please. Yes, please.
So my understanding was that you're restricted if you elect a CAB option. You're restricted as a broker-dealer from only calling on institutional accounts. And FINRA has expanded the definition of what constitutes a retail account in recent years to accounts that are 50 million and less, which is a very high number. So effectively, as I understand it, basically you can't call on multifamily offices, individuals, and in my world, I make placements to, smaller accounts.
Right.
So I don't understand how the CAB buys you a lot if you're just doing private placements because it excludes a whole class of investors. And the stuff that they gave us.
Yeah. Yeah, I can understand what you're saying. I do know some broker-dealers that only do institutional investors for private placement. I could see where you could say, rephrasing your question, Ted, hey, Kevin, they could have given me more. Or they could have made it a little broader. This is really a wonderful step, and maybe it will get broader as time goes on. You're going the right direction, because a lot of time regulations don't go the right direction. So maybe they'll make that broader. For the CAB rules, they do have a different definition of qualified purchaser from the regular set of FINRA rules, but I didn't want to drill down into that because I thought that would be confusing in the presentation. I just kind of want to hit it at a high level. But here's some latitude. So, yes, Brian?
Will there still be a requirement for audit and capital requirement?
Yes, unfortunately. The rules regarding audits and net capital and all that and focus filing doesn't change. Doesn't change. I just showed you a series of slides on CABs. I'm just going to show you one slide on SIPC. You need to have two takeaways. The first is the annual report on SIPC will be filed with SIPC. Slow down, Kevin. Well, that's because in prior years, the SIPC report was filed with the SEC with the assumption SEC was going to forward it. I don't know if that ever happened. So this year, and there's some auditors that probably don't know this, and your annual report on SIPC needs to be filed with SIPC. You can do it through email or you can do it through snail mail. You can see both up there. The other thing that I think is good is effective January 1st of 2017, the SIPC rate goes down. Right now you're at 25 basis points, you go to 15 basis points. Some good news. So that's all I want you to do as a takeaway on SIPC. Landmark decision, relief from prompt transmittal of customer funds. For introducing broker-dealers, that's a hot potato. SEC acknowledges that there's a lot of new burdens a broker-dealer firm takes on for a new customer. There's a lot of red tape, and red tape has only progressed over the years. FINRA rules, KYC, know your customer. You know that well for suitability and the like. AML AML didn't exist in the 70s. It's now part of what you have to do to vet a new client. And this SEC no action letter came out in July of 2016 if you wanted to research it. So let's take the situation Who does this apply to? Introducing broker-dealers, the IBs. Roughly 95% of FINRA's database, by the way, is introducing broker-dealers. Only 5% of firms carry or clear. It's that small. And the introducing broker-dealers are claiming exemption to the customer protection rule, the K2II exemption. I know you know this. This is who it applies to. Prompt transmittal. I could ask you a bunch of questions, but long story short, as you know, prompt transmittal is noon of the next business day. That is the definition of prompt transmittal. Now, there is a new exception, and I'll try to read this word by word. If the purpose for holding the check is to complete the broker-dealer account opening process in compliance with applicable FINRA rules. So you can hold the check if you're still going through the process and making sure the client is clean. If you do this, you have to have some safe harbors. There's probably about 6 of them. Let me just hit 2 of them. You've got to have some policies and procedures in place to safeguard a customer's check. That makes sense. You can't leave it on Lori's desk, the receptionist, right? And you got to disclose to the customers that they're going through a process, and it's a bit of a process for opening a new account with the broker-dealer and the carrying broker-dealer, just in case the client wants to see whether the check didn't clear within 24 hours. So you have to do this and a couple other things. So let me go back. So the other thing with the prompt transmittal of customer funds, you can see that's an exception only to new clients. So if you have an existing client, you still got to promptly transmit. It's just for the new clients that you get extra time to make sure they are no problems. Crowdfunding. Crowdfunding, I'll give you the top overview so you have a working knowledge on it. You know, it came out in the Jobs Act of 2011. As anything in government, it only took 5 years for the final regs to come through. I will try to present it from the CPA side, from the investor side, and from the broker-dealer side. Crowdfunding from the CPA side, you can raise up to $1 million, and Paula will talk a little more about that. You can raise up to $1 million. In the first round, when you do funding, you can do a review. Type of service is a review. And the review service is needed for a crowdfunding from $500K to $1 million. The review, very political, because at one point, the type of service they wanted was an audit. The price difference between an audit and a review is about 40% cheaper. And Congress said, look, if we're going to raise all this money, it really should go to the purpose of the firm and not to fatten the wallets of the CPAs. If you do a second round, you have to have an audit. And just the vernacular in the industry, a limited raise is anything to 100K to 500K, and you only need a review. When they write these rules, they're not on a calendar year basis, but they're on every 12-month basis. From the investor side, your clients. Well, I don't know if your clients make under $100,000, but if they do, if they have income or net worth under $100,000, the limit, the max, is $2,000. For people who like to know the rules, here is the asterisk on the bottom. It's the greater of 2K or 5% of the lesser of income or net worth. You can play with some numbers for an example. But 2K if you're under 100,000. Over 100,000, 10% of the lesser of income or net worth. So,
Kevin, I'm just going to
yeah, but, yeah.
There is actually a cap. Even if you had $10 million of net worth,
Yes.
you can only invest up to 100,000.
That's right. So understanding what Paula just said is my next question. Is there a limit in the amount an investor can buy? And it's 100,000. So just so you know all the limits, all the ranges where things roughly play out. And Paula will go more into crowdfunding and all the different ways you can do it. I'm not going to be stepping on her toes. I would like to tell you, as we've heard of crowdfunding in all different areas, I was rather surprised to see government was getting into crowdfunding. And why would government get into crowdfunding? Because they have budgets and allocations of funds, and if they don't have an allocation of funds, then they're short. And for instance, right now, Smithsonian is doing their second one, their second crowdfunding. They're looking for 300,000. They're trying to save Dorothy's slippers from the Wizard of Oz. I guess we have our priorities. The very first Smithsonian fundraising, they were looking for 300,000. They called it Reboot the Suit. That was Neil Armstrong's suit. They were looking for 300,000. They got $500 million in, and they also revamped or cleaned up one of Alan Shepard's suits and made it better. So I just thought it was interesting how pervasive crowdfunding is, and it's just not to the private sector, it's in other sectors too. The future, sitting on a park bench. So, there's many things I think about. I think about the NFL, they have the Breast Cancer Awareness Month. This is where the football players wear pink, but I wonder if it's a whole month, why they only wear pink for 1 week. I also wonder about sugar cubes. They seem to be disappearing. I don't know. I only see as packs of sugar. So I wonder about things. But when I wonder about the financial industry, it's robo-advisors. Robo-advisors. Robbie Robo, Rita Robo, the robo-advisors, and they're coming. Ameritrade, huge, just bought Scottrade. What is Scottrade? People who like online. They like doing it themselves. This is a power keg. You guys are sitting on a powder keg with the crowdfunding. With the robo advisors. The robo advisors. Right now they say. Let me look at the stats here. Right now in 2015, they say there's 60 billion with robo advisors. In 2020, they're expecting 2.2 trillion, and there's a huge issue whether robo advisors are fiduciaries and should be part of the fiduciary rules. Because with the DOL is pushing for people to have the cheapest service for their funds, and robo-advisors may be the way of the future. So I ask you, have we ever seen technology in financial services where people have been replaced? Yeah, I think we have. I think in ATMs, bank tellers. Yes, John. Yes, and I was talking to a plaintiff attorney yesterday about these robo rules, and they think it's very rich for potential litigation. So ATMs, now we have bank tellers, right? And no one thought ATMs would take on, but they did. By the way, I just thought it was interesting that the person who about 5 people thought about ATMs, but the one person who thought about it that I liked said, Sharon Shepard Barron said, if you can get a candy bar from a vending machine, why not money? So the future today, many customers prefer ATMs. They're convenient. They're everywhere. There's even 2 ATMs in Antarctica. And what's the probability I'll be in line, right? And the procrastination that they would fail, people wanting that personal relationship with Tommy Teller, it turns out just people just want to get their money from the bank. So, and there is a new generation of buyers out there. The Gen Xers love technology. In fact, they always have it in their hand. And I don't know why they wouldn't buy stock with the faceless help of something like Watson or Siri, or maybe they'll have something like Leary, which will make some stock suggestions. And then I sometimes worry because I get suggestions from eBay and Amazon and Netflix on what I should be picking or buying. And I always wonder if this could lead to some type of undiversified portfolio. Well, in conclusion, George Carlin is who I referred to earlier. And George Carlin said, just when they discovered the meaning of life, they changed it. Thank you.
All right, thank you, Kevin. Do we have any questions? All right, why don't we take about a 5 to 10 minute break if you'd like. Make your phone calls, go to the restroom, get some more coffee, have a roll, whatever, and we'll be back in less than 10 minutes. It gives me great pleasure to introduce our third speaker today, Dennis McCarron, who's the CEO of Reg Maven, Inc. She's a senior executive with more than 27 years' experience running broker-dealer and registered investment advisor businesses and leading teams in the financial services industry. He's been successful in implementing customized compliance policies and operational strategic business plans. And he's managed annual compliance requirements for investment advisors and broker-dealers, including, and he's got a couple of SEC regulation paragraphs here, 2064-7 and FINRA 3130. Is that right, Dennis? And compliance functions. Anyway, Dennis will be providing us with valuable insight into navigating the regulatory minefields that all of us face with increasing trepidation, with a particular focus on specific Department of Labor and SEC rules. Please welcome Dennis McCarron.
Thank you. Good morning. How's everybody doing? So I get the lucky subject of DOL and ADV. How boring. So please do what you can to stay awake during this. Now, there's a lot of information out there on the DOL changes. They've been coming up since 2009. There's probably almost an equal amount of change on the ADV amendments. That's been long waiting. So with that said, if you need detailed information, there's this site called Google. Go to it. You're going to get a lot more information from that in great detail than I'm going to give you today, because that subject matter on each one of them is a 2-hour presentation and a discussion. And I'm going to be struggling to keep you awake for the next half hour, so I'm not going to drill in too deep on the 2-hour piece. So let's start off with the DOL. What does the rule mean? It means you need to be a fiduciary. It means that you need to act by the prudent man rule. And for RIAs, you lived by this. For broker-dealers and insurance agents, this is a new concept to you. And theoretically, when you get up in the morning and you shave, you're a fiduciary, even if you're a broker-dealer or a insurance agent, for the most part. But now you're going to be held to that standard in writing and in a rule. So what does that mean? What does the DOL piece mean? It means that you need to be able to make sure that you're operating in the best interests of your clients, that you and your firm is operating in the best interests of your clients. And we'll get into a little bit of the detail on that. The rule started back, like I said, in 2009, where they started to do a lot of investigation. They came out with a proposal in 2010, and they came out with another proposal in 2015. They gathered over 300,000 comments. I'll keep that other comment I said yesterday at bay. So they kept 300,000 comments, and they reviewed all this information. They had public meetings. They talked with law enforcement or government officials, and they did what they could. This is a new venture for the DOL, because if you remember or know, the DOL, they audit plans. They audit ERISA products or ERISA plans. They're now venturing into being able to supervise you. So what does that mean? Does that mean that you have a new regulator, the SEC, FINRA, the states, and now DOL? Yeah, very much could be. Are they going to come in and regulate you? I don't know. It's going to take them a while to put those resources, expertise, and everything like that in place. But yeah, they can. So they gathered as much information as they could. what they're looking for is to make sure, like I said, that you're going to operate by a prudent man rule, and they're going to document that to the best of a regulator's ability. You have to provide investment advice. So normally, like from a broker-dealer's or an insurance agent's perspective, I'm providing advice on a variable annuity, a fixed annuity, an equity indexed annuity, a life insurance product that has cash value. You know, a lot of times you see that in different plans or different types of products. Now, when I make a recommendation, is that advice? Well, the DOL has problems with that. So they said, we're going to go and we're going to live by the standard of recommendation and advice that FINRA put out. Because FINRA is this really big organization. They've been around for a really long time. So we're going to follow their rule and their guidance on that. So they went, and so if you want to know, it's under Rule 2211, which is the suitability rule. If you look that up, there's no definition. It's just guidance. So it boils down to, if you make a recommendation, what you see is what you get, and you know it when you've given it. So it's very subjective. And that happens to be orally done and also in written format. There's also a couple of NTMs as I look down here, NTM 0123 and 1102 that talk about recommendation. If you go to these things, don't have a high expectation that you're going to get an answer, but it's going to give you a little bit more information about what the spirit of what they were trying to put in writing. Then they said, all right, so now what are we going to do? How are we going to not totally disrupt this industry? Because the DOL historically, as I said, has been with ERISA and plans, KIOs, SEPs, 401ks, Simples, all of that stuff. But now it includes IRAs. So that's brand new for them. So how are we going to level the playing field without making some type of exemption? So they put the best interest contract exemption in place. And that really was put together so that commissions and concessions can still be implemented and done as long as you follow some different guidelines. Not rules, but guidelines. And also you have to file, in order to take advantage of that, what they call BICE, you have to file a prohibited transaction exemption. And you file that with the Department of Labor. Now, each advisor doesn't have to do that. That's done at the firm level. So an insurance company or a broker-dealer or whoever is the firm that's distributing would have to go and take advantage of that exemption. And you file that with the Department of Labor. And if you want to know more about that, it's PTE 8424, which is for the Department of Labor's and for the BICE exemption. It's called Prohibited Transaction Exemption. So what does BICE mean? What's the summary of it? It's acknowledgement of your fiduciary responsibility. You're going to give prudent advice. Don't lie. No misleading statements. I mean, this is not rocket science, but they have to say it because, unfortunately, as Mary Jo White has said, there are bad actors out there, and she's going to find you, and she's going to get you. And as Kevin showed you earlier with FINRA, that's coming up, and they will get you. I sit on the Department of Enforcement's hearing panelists, and I hear a lot of these cases. Some are really, really just stupid. And other ones is, okay, the guy messed up, but he didn't know. But they're going to get you. And as the fines increase and everything like that, you know, it's coming down, and DOL's now in play. You're going to have to draft supervisory procedures. Now, when you go into, if you're offering retirement accounts, you have to adapt your policies and procedures for that. If you're going to take advantage of the BICE exemption, you're going to have to adapt new policies and procedures for that. You're going to have to disclose your fees, your conflicts of interest, which means your concessions and your commissions and your advisory fees. And remember, when you're also talking about advisory, about recommendations and that, it just doesn't talk about investment advice. What you're also including is you're recommending that they move plan sponsors or they move platforms. I'm going from Fidelity to New York Life, or I'm making different recommendations on services. That you're acting as a fiduciary in that role as well, because you're working with the plan sponsor who's a fiduciary or should be a fiduciary for the plan itself. So don't dig deeper, look deeper. Just don't think it's investment advice like it has been historically with an RIA and so on. Now, this is another one that you have to do. You have to create a website. And your website or web page off your website has to address BICE. So you're going to have to put into your website everything that you've got. Your firm's business model. What is my business model? What do I do for this? What are my fees? What are my concessions? What are my my conflicts of interest? It's a complete discovery for your investors or your potential retirement investor on what your services are. You have to talk about what your policies and procedures look like. You don't have to put your policies and procedures up there, but you have to describe what they are and that you have them in there. And your compensation and so on like that. So that's a big decision. How am I going to get there? How do I know? How am I going to figure out if this is an exemption that I want to take advantage of? Well, it's obviously a business decision. And you got to know before April 17th of 2017. And then you have to have everything in place for BICE by January 1st of 2018. That doesn't exclude you from being a fiduciary between April and January. You still have to be a fiduciary, but it gives you time to put your BICE exemption policies and procedures and filings and everything like that into place. So you got a transition period. Obviously, the industry is kind of up in arms about this. Not sure where to go. I think the biggest impact is going to be on the insurance industry. They're the ones that have historically always run by concessions. You know, if you have a broker-dealer, most broker-dealers today have at least a component of an RIA or a fee-based in their mix. So it's not a complete transition for them. They understand fees and how to sell fees and who best deserves fees. But it's the insurance industry that's really, I think, going to take the biggest hit on this. And we know the insurance industry is a big industry. So it's going to cost some money, obviously. The DOL is estimating that this is going to cost about $792 million over the next 10 years. The industry says Ameriprise is going to spend $7 million in the first quarter. Cambridge Research is going to spend $10 million in the first quarter. And the real estate and the associations have come out and said it's going to cost $11 billion by 2020. Because this is not a one-time thing. You're going to have to keep doing this every single year. Update policies and procedures, make changes that the DOL make changes, and so on like that. And as I mentioned, the DOL could very much knock on your door like the SEC, FINRA, and everybody else does. So are there opportunities? Yeah, it could be. Depends on your business mix. I look and I say there's 4 types of business models here. You've got your FINRA member broker-dealers. You've got your fee-based RIA only. And you've got your insurance agencies. And then you get the hybrids, your wealth managers. That's a little mix of everything, which means their compensation's coming in various different ways. The insurance industry, like I said, is going to have the most difficulty with this. and the adaptation of how they're going to change their products and services, how they're going to change the pricing of their products. Do they have to change their pricing of their products? You know, it's going to take some work. And if you look at the insurance products, you know, you may have an equity index annuity that you're going to put into an IRA, and it's got a 10-year surrender charge, and I'm going to get 8% commission on it. Then you've got another insurance product that's a 10-year equity index annuity, pretty much the same, and it's got a 5-year surrender charge, and I'm going to get 4% commission. Well, I got to pay college tuition this month. I got to get that new Mercedes. I'm going with this one here. You better be able to defend that product and that sale when somebody knocks on the door and asks you why. So there's a lot of senior management decisions that need to be made, and you're going to have to take a hard look at what your business models is, where your income's coming from, and so on. 2 large firms today have totally pulled out of even thinking about BICE. Merrill Lynch and Commonwealth Equities. Other ones are still in the process of trying to decide how they're going to adapt their business to it. So those are 2 big statements. So what's the motivation? The DOL, I think, wanted to jump on the bandwagon a long time ago and say that ERISA plans and IRAs or any type of retirement accounts are costing the consumer an enormous amount of money. And we need to figure out how to level that playing field. Now, in some cases, and this is the personal opinion of myself and not anybody else, those industries that they're targeting, they created the problem themselves. And this is a way that DOL's finally coming in and trying to level the playing field. Are they doing it the right way? Probably not, but do they have the spirit right? Yeah, I think they have the spirit right. So you want to look at what is my business? So do an analysis. Pick out what you want, what your business looks like. And then you want to take a look at what your risks are for changing that. Where the income is coming from. Where's your assets lie? Is your assets in RIA business? Is it in insurance? Is it in brokerage? Where are my top 25 or 25% or 50% of my brokers? How are they going to react to this? And how is the industry on product vendors going to react to this? Are they going to change their compensation models? Are they going to create a retirement plan only product line? So you need to take a look at all of that before you come up with making a decision. Am I going to go on? Am I in or am I out with BICE? Because that's going to take a lot of impact. It's also going to take a lot of time, and you can't wait. You got to do it now because you only have until April 1st or April 17th to put that into place. And then I would take a look. If I'm in, then I would take a look and find out, okay, where is all this coming from? Where's my top revenue coming from, and how do I need to adapt it? Put a plan together and analyze that plan. Meet with your advisors, meet with your reps, and meet with senior management. You're going to have to design all your different manuals, including operations. Operations may take different workflows to process this paperwork and this type of business line, because you're going to have more disclosures, you're going to have more communications with your advisors, more communications with your clients, and which means that puts another burden on compliance to make sure that all the communications are accurate and correct. So there is an opportunity. If you decide you want to go forward with this, you look at your clients and they say, okay, I'm going to make sure I want to move these assets over into a fee-based. Well, do an analysis you've already done. Take a look at what the business lines are. Take a look at what your products are. Are they in-house? Do you do investment management in-house? Do you have asset gatherers or asset managers as advisors? Are you using third-party money managers? And then try to figure out the best way to move those assets from your brokerage accounts over into your fee-based. And that might be an opportunity for you. Remember to take a look at your surrender charges on any type of products that you go to move, and do not incentivize people to make any changes, because that won't be good. You're no longer fiduciary. There's two views on valuation. Mark Bergeron says that the valuations of these firms is going to decrease, and there's an individual by the name of Dan Seaver, who's a consultant, who says it's pretty much going to stay status quo, but it's not going to decrease. Who knows? The rule's not in effect. It hasn't been able to be tested yet. You've got a couple of firms out there, as I mentioned, that are automatically pulling out of the BICE. And that's probably the biggest decision piece that you have to make. Always behind on the slides. So SEC, this has been a long awaiting amendment to the ADV. They really want to drill into your SMA accounts. Now again, the regulator has done a wonderful job at defining what an SMA account is. All they've done is define what an SMA account is not. So an SMA account is pretty much everything, unless it's run by somebody else, or it's a mutual fund, or it's a unit investment trust, or whatever that might be. They haven't done a great job at defining what it is. They've done a better job at defining what it's not. So they want to know, and this is going to be on your ADV, how are they managed? What securities are they in? And they're going to give you 12 broad ranges of categories for securities. So think about this. Where am I going to get that information? Well, most of your information, if you're not self-clearing, is with a clearing firm. How does that clearing firm profile those securities? They may say an equity fund, well, because it's made up of stocks and bonds, I'm going to put that into growth and income category. And the other firm doesn't have a growth and income category, and the SEC calls it a income and growth. How am I going to do this? So you got a lot of data that you've got to go through, because they're going to give you the 12 categories. So you got to make sure that your custodian is reporting it so that you understand it. You got to make sure that you can understand it, and you got to make sure that your policies and procedures are crystal clear on this, because as we know, when FINRA or the SEC walks into your shop and they find one little thing, that's an invitation for them to go deeper. You don't want to give them that invitation. So do your work up front. They want to know the use of derivatives and borrowings. So if you're leveraging that portfolio at all, they want to know what you're doing with it, why you're doing it, and what the outcome is, and everything. They want to know where your assets are held. So if you have a custodian and they're holding, if say you have 5 custodians, and each custodian is holding more than 10% of those SMA assets, you've got to disclose that. And they want to know who's investing in them. They want to know more about your client base. Now, what I tried to find, and I was unsuccessful, I'm not even sure it's out yet, is a sample new ADV, because I was going to pass that out today, but I couldn't find one anywhere. And so we're going by what the rule is right now, or what the amendment is. The umbrella registration. If you're an investment advisor and you have multiple private funds, this exemption has been out there for a while, but now they've kind of tightened it up and made it a little bit more easier to do, because now they have on your ADV a relying advisor and a the fund. It makes it easier, it makes it more streamlined. So now instead of having 15 ADVs, you're going to have one ADV, and it just makes it easier for you to be able to report on that. What they did put together, though, is your filing advisor is responsible for every action in your relying advisor. So CCO, CFO, CEO, COO, all that reports right up to the filing advisor from the relying advisor. They also want to know now more about your internet presence. Not for your advisors. Let's say you have 100 advisors and they're all independents and they all have DBAs. You don't have to file their social media or their websites or anything like that, but you do have to be aware and you have to supervise them. You have to file with the SEC on your ADV your social media, your websites, your Facebook, whatever it might be. And they're going to put a plan together. FINRA about 10 years ago built a task force to go out and look at all of the broker dealers' social media. They Google before they come in to do a audit. They Google you. They find out more about your reps. They find because they got the BORAM and so on like that. The SEC on ADV also is basically building their own BORAM, which is all your branch offices. They want to know about the top 25 branch offices. They want to know who's in them, why they're in them, what are they doing, who they're doing it to. So the ADV is going to get fairly extensive. They also want to know if you outsource your CCO. A lot of small RIAs will outsource the CCO capabilities because the CEO says, I don't wake up in the morning and think compliance, but I also don't have enough business to qualify for a full-time CCO. So there's firms out there that will act as your outsourced CCO. But they also want to know what the EIN number of that CCO is. Gee, I wonder why. They walk into your firm and they find out that there was these infractions. Well, they're going to find out all through all the other CCO responsibilities that individual or company has, and they're going to find out if the same infractions are there. So it's transparency. The assets that you have to report on for your SMAs is you do it once a year at your filing amendment. If you have 10 billion or more in assets and SMAs, you do it twice a year. You only file it once, but you do it at that one point. So you take half year and then the following year. Communications, it's no longer 10 people, it's one person for investment performance. And I've got probably about another 15 minutes and I know we're running late, so I'm going to shy out right now. But the SEC I'm going to leave with two things. The SEC is creating an enormous amount of transparency. They first started out with what they call NEAT, and NEAT is a national exam tool. It's a micro system that looks at every single one of your trades, from the firm level to the registered rep and the IA level. They gather this information from your clearing firms. Then they also created a few years ago what they call MIDAS, the Market Information Data Analytics System. That's a macro system. And the macro system looks at all the exchanges. So they look at trends, they find out what's going on with the marketplace, and now they've got the macro, they got the micro on trading, and now they got a completely transparent ADV. They can walk into your firm and know more about your firm than you do. And that's a scary thought. So their exams are going to be more pertinent, they're going to be more pointed, they're going to be able to discover things that you may not be able to discover, because for NEAT, what they can do is they can pull out the trading for XYZ advisor. They can track that against the corporate actions database and find out that IBM came out and said they were going to buy XYZ. Three milliseconds later, all of a sudden, that advisor traded an enormous amount of stock. Guess what? You're going to have a knock on the door. So their transparency and they know who the advisor was, they know where the advisor sits, they know what branch office is. So they may not even go to your home office, they may go right to that branch office. Get your policies and procedures in place, make sound decisions, and enjoy your next exam. Thank you.
Do we have any questions for Dennis or for any of our speakers today, or just questions in general?
I've got a question for Dennis.
Paula?
When you said, that Merrill Lynch, and I think Commonwealth
Equities.
equities are, they're not yet under this vice?
No, they're not going to take advantage of the BICE.
And what is
That means that they're going to no longer sell commissionable products to ERISA or RIA accounts.
Oh,
They're
okay,
only
that's
doing fee-based.
significant, yeah.
Yeah.
Thank you.
Yep.
Anyone else? What I'd like to do, this will conclude our session today. You'll go back to work early, answer your emails. And thank everybody for coming today. And we look forward to seeing you next year, perhaps in the same location. This certainly was satisfactory as far as I can see. And also, for those of you who may be new to the seminar process, who are not existing Breard or Argento or Reg Maven clients, if you would, leave your business cards in the back with Amy, who's standing in the back there, so we know where to reach you next year for next year's session, and update on what's going on, because the landscape seems to change pretty much every day or every year. Anyway, thanks all of you for attending today. I hope you enjoyed it and got something out of it, and we'll see you all next year.